balance. Do you understand net balance here? Yeah. So now we have to record it as a country. That's why they said national economy. That's why they said what? National economy. That means as a country. So what do we do as a country? We have our visible trade. Examples of visible trade, we have food and beverages, we know that, right? We have oil and gas, we have manufacturing goods. All these are what? Visible. So the ones we take out of this country are what? Our exports. Do we get our exports here? So if we export foods, beverages out of this country, that means we produce food here and we send it out of this country, it's going to be recorded in our balance of payment, current account, exports. Do we get it? So these are our exports. Then if we take food from outside of this country, maybe from Turkey, from Germany, or wherever we take it from, it's going to be registered in what? Our balance of payments, current account, imports. So this is what the export thing, the products, the food we sell to other countries. And this is what the food we bought from other countries. Do we understand? So the difference between our export and our import in terms of food and beverages is our net balance of food and beverage. Do we get it? So this is our export. Export minus import gives us net balance. So these are our net balance. So for exports, for visible trade, food and beverages, we have the export, we have the import. The difference between them gives us our what? Net balance. For oil and gas, we know oil and gas, right? We export, we import. So if we have exports, we record it here, and we take it away from the sum of our imports. That means our export revenue minus our import expenditure. Do we get it? Export is our revenue. The money comes back to us. Import means what? We are paying out. That's an expenditure. So we have what? Export revenue, import expenditure. Do we get it? So the difference between our export revenue from our import expenditure is what we call net balance. So export revenue minus import expenditure is what? Net balance. Do we get it? So here we have manufacturing goods that we manufacture. That means maybe we have factories here, we produce. So those goods that we produce, we record it, that we send out of the country, we record it here. And the ones we take from other countries, we record it here. So the difference between these and these sources. So here we have what? Visible trade balance. So the total of our visible trade in terms of export and import, the difference is what we call visible trade balance. Do you understand visible trade balance here? So we represent it as what? A. So our visible trade balance is recorded as what? A. So in A, what does it mean? It means that the total of our export revenue from our import expenditure in terms of visible trade, in terms of goods or products that are seen, that we can see, that we can touch. Do you understand visible here?
Yeah.
So that gives us our visible trade balance. Then we have the invisible trade balance. We're talking about services. So here we're talking about transportation. Transportation is service. It is intangible. We can't touch it, but we can feel it. It's a service. So if there's transportation that we export out of this country, we record it here. And the ones we take into the country, we record it here. So the difference gives us our net balance on transportation. Do we get it? For financial services, such as banking, insurance, and sort of. So this one's what? Our export, we record it, then we take it away from our import. So this will give us invisible trade balance, which is B. Our visible trade balance is represented as A. Our invisible trade balance is represented as B. Do we get the difference here? Yeah. So that the record of what? All exports in terms of invisible trade minus all imports in terms of invisible trade will give us our net balance of invisible trade, which is B. Do we get it? Yeah. Then we have income flows. Income flows are wages, dividends, interest, and profits. This shows what? Investment of our country out of this country. In terms of maybe we have banks like the Libyan Investment Authority. There's what we call LIA. Libyan Investment Authority. It's a company owned by Libya. It's an investment. It's owned by the Libyan government, but it's not here, it's in UK. So what do? They invest Libyan money, or they invest Libyan money in whatever they can invest it on. Then there will be return. So this is part of what we call income flows. So every year, in every year, they return what? Interest or profits at each year. So these are what we call income flow. So your total income flow in terms of exports minus your total income flow in terms of imports will give you your net balance of what? Income flow. Some companies also investing here. They have to take their money or their fund at the end of the year. So when they take it off, you minus it from your own. So investment of other countries in our country has to go back to their country. Our own investment as a Libyan, our own investment out of this country has to come back to us. Do we get it? So multinationals that have investment here take their capital out of here to record it in what? With their own balance of payment. And whatever investment we have as Libyans, we take it back here to record it in our own balance of payments too, as exports. Do we understand the difference here? So your total inflow in terms of exports minus your total inflow in terms of imports will give you what? Your income flow balance, which is C. Do we understand? Then the last one is what? The current transfer. The transfer of funds. I am working in here. So whatever I make in terms of cash, I take it back to my country. That's what we call current transfer. And the Libyans, doctors, lawyers outside of this country, they return their cash into here. It's what we call current transfer. Do we understand current transfer here? My money doesn't stay here, it goes back to my country. Libyan immigrants, that is immigrants, people that are out of here, that are Libyans, their money comes back to their country too. So this is also what? Part of our current transfer. So there's current transfer. So the current transfer will be added because in current transfer, there's something like import and export. Current transfer comes back to you, you're not importing it, you're not exporting it. The number of funds we Libyans are able to make out of this country back to our country. The number of money or funds we can put together as Nigerians that will take out of this country back to our country is our own current transfer. Do you understand current transfer here? So the government of Libya will record this in their balance of payment as what? Current transfer. So all the amount of money that comes back to Libya by the Libyans out of this country, outside of this country, will come back to Libya. So whatever they bring back to this country will be recorded where? The current transfer. Do we understand current transfer here? So current transfer is what? The amount of money that comes back to you as what? The amount of money that you send back from your outside, from you being a Libyan, working outside of this country, the amount of money you bring back to your country is your current transfer. Do we understand current transfer? Any question about current transfer? So, how do we calculate our current account balance? So our current account balance is what? Visible trade. The visible trade balance plus invisible trade balance plus income flow plus current transfer gives us our what? Current account balance. Do we get it? So at the end of it all, we need to get our current account balance. How do we get our balance of payments? And for every economy, we trade in and out. That means we buy, we sell. So we transact with other countries. So because we transact with other countries, there's what we call balance of payment. So whatever goods we are transacting, whatever imports we do or exports we do, it has to be recorded. So we have to record our transactions with other countries. So the cost of recording the transaction with other countries is what we call what? Balance of payment. So what is balance of payment? I wrote that it is a financial record of a country's transaction with the rest of the world for a given period of time, usually over a year. So our transaction with the rest of the world, the Libyan transaction with the rest of the world, is what we call balance of payment, if it is recorded. So the record we have in terms of exports, in terms of imports, from here outside or from outside in here, is what we call net balance. Do you understand net balance here? So now we have to record it as a country. That's why they said national economy. That's why they said what? National economy. That means as a country. So what do we do as a country? We have our visible trade. Examples of visible trade, we have food and beverages, we know that, right? We have oil and gas, we have manufacturing goods. All these are what? Visible. So the ones we take out of this country are what? Our exports. We get our exports here. So if we export foods, beverages out of this country, that means we produce food here and we send it out of this country, it's going to be recorded in our balance of payment, current account, exports. Do we get it? So these are our exports. Then if we take food from outside of this country, maybe from Turkey, from Germany, or wherever we take it from, it's Before we register the what? Our balance of payments, current account, imports. So this is what the export thing. Do you understand the difference here? Yeah. So invisible export and invisible import give us what we call invisible trade. Because trade is import and export. Is it clear? Then we have our balance of, okay, then I said invisible trade. It is the record of export and import of services, intangible products such as banking, insurance, shipping, and tourism, and even teaching. So when we have foreigners coming to this country as tourists, it's invisible exports. Foreigners coming to this country as tourists, it's invisible export for us. Yeah. Do we get it? Because they are foreigners, they are here for tourism. The money they pay comes to our own economy. So that's why it is what invisible export. But we Libyans, when we go out of this country, in terms of tourism, it is invisible what? Imports. Do we get it? We are going out. That means we are spending out of this country. It's invisible import. Do we understand invisible import and invisible export? So there we have what we call balance of trade. As you have the balance of payment, you have the balance of trade. So what is the balance of trade? It is the sum of the visible and invisible trade balances. So the sum of the visible trade and the invisible trade, the difference between the invisible trade and the visible trade is what we call our balance of trade, BOT. So look at the formula. BOT is what? Total export earnings minus total import expenditure. Total export earnings, that means what we earn in terms of exports minus what we spend in terms of imports will give us what? Our balance of trade. Do you understand balance of trade here? Yeah. So when our export earnings is more than our import expenditure, we call it balance of trade surplus. And when our earnings is less than our expenditure, we call it balance of trade deficit. Do we get it? Do you have any questions about balance of trade? So look at what balance of trade is here. Total export earnings. What we earn, that's our revenue. This is revenue. Minus our total import expenditure. That means we spend. In terms, whenever there is import, it means we are spending. So the total of what we spend, you take it away from total of what comes into our economy in terms of earnings, which is revenue. So when you take it away, you have a balance of trade. Do you understand balance of trade here? So that's balance of trade. And balance of payment says what? The record of a country's transaction against the rest of the world. And it has three phases. We have the current account, the financial account, and the capital account. So the capital account does what? It records our assets in and out of this country. The current account records our earnings. The current account records the total number of what we get in terms of buying and selling. And the financial account records what? Our income, such as profit, interest. Do we understand the difference here? Yeah. Capital for assets, financial account for our investments in terms of loans and equity. And the current account is our trade, in terms of goods we buy, in terms of services we buy, in terms of goods we sell, in terms of services we sell. Do we get it? Yeah. So in our current account, that's where we can balance our trade. So we have the current account. So the former we have the visible trade, the invisible trade, the income flows, and the current transfer. The current transfer is the amount of money we make as Nigerian, the amount of money I make and the amount of the money Nigeria makes that they send back to their country. The amount of money Libyans make out of this country that they bring back to this country. Current transfer. Do we get current transfer here? Yeah. Any question about this? No. Is it clear? Yes. Okay. This is balance of payments. And for every economy, we trade in and out. That means we buy, we sell. So we transact with other countries. So because we transact with other countries, there's what we call balance of payment. So whatever goods we are transacting, whatever imports we do or exports we do, it has to be recorded. So we have to record our transactions with other countries. So the cost of recording the transactions is what we call net balance. Do you understand net balance here? Yeah. So now we have to record it as a country. That's why they said national economy. That's why they said what? National economy. That means as a country. So what do we do as a country? We have this balance of payments. And for every economy, we trade in and out. That means we buy, we sell. So we transact with other countries. So because we transact with other countries, there's what we call balance of payment. So whatever goods we are transacting, whatever imports we do or exports we do, it has to be recorded. So we have to record our transactions with other countries. So the cost of recording the transaction with other countries is what we call what? Balance of payment. So what is balance of payment? I wrote that it is a financial record of a country's transaction with the rest of the world for a given period of time, usually over a year. So our transaction with the rest of the world, the Libyan transaction with the rest of the world, is what we call balance of payment, if it is recorded. So the record we have in terms of exports, in terms of imports, from here outside or from outside in here, is what we call